If globalization has failed, then what replaces it? Because when a superpower publicly declares that the operating system of the last 40 years no longer works, that is not rhetoric. That is regime change at the structural level. And structural change does not move in headlines. It moves in phases. Today, we are not watching random geopolitical noise. We are watching the reinvention of the global order in real time. From our perspective, the key shift is not emotional. It is mechanical. The liberal world order, imperfect as it was, relied on free capital flows, persistent trade imbalances, and financial asset inflation as a stabilizer. That system produced large deficits in the United States and large surpluses in export economies. It also produced rising domestic inequality and political stress. What is emerging now is a shift toward defensive mercantilism, not the 19th century imperial version, but a model built around reindustrialization, capital direction, supply chain integration, and security alignment. The mechanism matters. When trade deficits shrink, capital flows change. When capital flows change, asset pricing changes. When asset pricing changes, volatility increases. And when volatility increases, policy becomes more active, not less. This is why Japan matters. Rising Japanese bond yields are not just a local issue. They pressure global rates. They influence currency swings. They alter the carry trade. And if those pressures transmit into treasuries, they reshape global liquidity conditions. This is why Latin America matters. Resource security and regional integration are not symbolic. They are inputs into industrial capacity and geopolitical leverage. This is why Taiwan matters. Not only for semiconductors, but for naval geometry and alliance structure across the Pacific. We are not watching isolated events. We are watching phase pressure build. Our base case today assigns roughly a 55% probability that we remain in a transition phase through mid-2026. That means volatility without systemic break. Around a 30% probability sits on accelerated fragmentation into hardened regional blocks by late 2026. And about 15% remains on policy miscalculation, triggering financial stress that forces central bank coordination. Those probabilities will move based on confirmation signals. What are we monitoring? First, capital redirection. Are surplus nations investing productively inside the United States, rather than recycling into treasuries? Second, defense spending acceleration across Japan and Europe. Third, trade balance compression in the United States. Fourth, sustained upward pressure in long-duration yields without crisis intervention. If those signals confirm, then the structural transition is advancing. Now, before we continue, if you value this kind of probability-based, mechanism-focused macro analysis, consider subscribing. The benefit is not access to predictions. It is developing a clearer framework so you can distinguish signal from narrative noise during volatile periods like this. Back to the structure. Europe is the most uncertain node. It faces a binary path: align more deeply with a US-led industrial bloc, or attempt strategic autonomy with limited fiscal cohesion. We assign a 60% probability that Europe ultimately aligns, rather than fractures. But that path likely involves internal political turbulence through 2027. China's trajectory depends on response. If it accelerates domestic consumption and regional integration, pressure moderates. If it doubles down on surplus expansion, friction intensifies. And the dollar? Structurally, a successfully implemented mercantilist transition does not require a weak dollar collapse. It requires a managed range. Cyclical strength is still possible during stress episodes, even if the long-term valuation resets. Quick note: this discussion is for educational purposes only. We are analyzing structural dynamics, not providing investment advice. The larger point is this: the next decade will not resemble the last decade. Asset pricing will not be driven primarily by central bank liquidity expansion. It will be driven by capital allocation, industrial policy, and geopolitical alignment. That means sharper rotations, higher volatility, more frequent narrative reversals. But it also means clearer structural signals for those watching the right indicators. Our role is not to predict the exact path. It is to map the probabilities, track confirmations, and adjust when evidence changes. Globalization may be fading, but systems do not disappear. They evolve. And the evolution phase is where mispricing and opportunity both tend to emerge. We will continue monitoring the transition, the capital flows, and the policy sequencing carefully, because in environments like this, understanding the mechanism is more valuable than reacting to the headline.